I'm going to introduce a pretty big name right now. I'm a little bit scared to do it, but this guy has been putting out key insights with tens of thousands of eyeballs on each insight every week for the last several years. And now he's got a podcast called The Rent Roll that he's doing in partnership with Madera Residential, a multi-billion-dollar multifamily shop. He's been key insights for companies like RealPage and now with Madera Residential. I am so excited to introduce Jay Parsons. After 3 years of invitations, he said yes. Come on out here, man.
And that was when I kissed her, and then she made my lips hurt. I could hear the chit-chat.
All right, good morning, everybody. Thanks so much for having me. I wasn't saying no because I didn't want to be here. It just never really worked out with the schedule. I'm glad it did this year. So I'm going to talk to you about what's going on in the multifamily housing market and give you a little bit of perspective on what might happen in the year or two ahead. So before we get into it, though, before I just lull you to sleep with a bunch of PowerPoint slides, I thought I'd give you some trivia, okay, just to kind of give you some, really next time you're at, obviously everyone here I know the answers, and you go to the next industry event, you're at happy hour, you can wow everybody with your rental housing trivia knowledge, all right? So I got 2 questions for you to kind of warm us up a little bit. Number 1, we have a new HUD secretary, Scott Turner. He's the second former NFL player to become Secretary of Housing and Urban Development. Does anybody know who the first one was? Jack Kemp, yes, the great Buffalo Bills quarterback. He was the first. So another related trivia point to you, by the way, is that we now have had more former NFL players as Secretary of HUD than we have had HUD secretaries with previous history in private sector housing development for housing and urban development. So Scott is also the first HUD secretary who actually has a background in private sector housing development. Second question, which U.S. president was not a homeowner when he was elected to the White House? He actually called himself a renter. It was Truman. Yeah, it was Truman. Truman was a tenant of his mother-in-law's. So you can imagine how that would go today. I think that might not go so well, but thankfully it wasn't used against him. So he lived with his mother-in-law, did not become a homeowner until she passed away, and he and his wife became the owners of the property in Missouri. All right, and then not a trivia question, but I'll tell you the next thing I wanted to just kind of briefly touch on is the fact that one thing I love about our industry in multifamily and single-family rentals is that it is incredibly diversified. And I want to show you a couple charts here just to kind of, again, want to warm us up a little bit here. This is the market share of the top 50 owners of apartments and single-family rentals in the U.S. And you see a lot of headlines saying, "Oh, these behemoths, these big names." You see these big trades of the Progress Residentials, Invitation Homes, American Homes for Rents, the Gray Stars, the Equity Residentials. None of these guys have even 1% market share. So even the biggest players are just not that big. They do not have that much influence over the market. It's an incredibly diversified market that's primarily controlled and dominated by very small operators. And I think that's exciting because, we see in our industry all the time, newer groups being formed, leaders splitting off of one group, forming another group. There's new capital coming into the space, especially in this last cycle all the time. And, it really creates more opportunities than other industries where you have they're really dominated by a handful of players outside of commercial real estate. So, I can't even think of any other sector quite like this, except maybe like restaurants, something like that is this diversified. And so that's a really powerful thing, and I think it's one of the wonderful things because you could have lots of different strategies, lots of different markets. You could have your favorite this or that, and you could still find success in rental housing. All right, so now with that out of the way, let's get into the death by PowerPoint stuff here. All right, so let's talk about what's going on in the multifamily housing market today, and I'm going to show you just in the next 8 or 9 slides. I'm going to talk about kind of where we are right now, and then we're going to get into a little bit of where I think this is going. And so the first thing I want to point out is that we've got anybody who's in how many of y'all are, by the way, just in some way or form invested or operating in multifamily and apartments? Is it a lot of you? Almost all of you? Okay, so there's obviously challenges everybody knows right now in multifamily. But I want to make, one thing I always want to make very clear is that demand is not the issue. Now, you may not always feel this at your individual properties. Maybe your vacancy rates are higher than they were previously. But on a macro level, it's not a demand issue. There's a lot of demand. In 2024, we had our second best year for net absorption, total move-ins minus move-outs, in any year going back 3+ decades. The only year better was 2021. So there's a lot of demand. The issue is that there's also even more supply. We have a lot of supply. We have supply at the highest levels in 50+ years. And so what's happening is all this demand is being spread out among a greater number of properties. And so that's why if you even in the smallest portfolio to largest portfolios, you don't always feel this surge in demand like we did in 2021 back when there was very little supply in the market. So we completed almost 600,000 units just in the past 12 months. All right, that's a lot of supply. This is really, it's funny, I started in this industry in 2009, great timing. And what was interesting in the 2010s decade is especially from Wall Street, the narrative is always, oh, so much supply, so much supply. And I would go to a lot of events, speak to investors, and say, look, it's really not that much supply. The demand in many cases, and even these Sunbelt markets, was greater than the supply. Now what we're seeing is truly what a lot of supply means. I don't think these are numbers we're going to see anytime again in our careers. All right, so then more good news here, and I'm kind of giving these signals of good, bad. On the green light here, the good sign is that apartments, while we've seen this is occupancy rates, they've come down quite a bit. That we've been spoiled these last few years. They're still in pretty good shape, and I think one of the great things we've seen about apartments is the resiliency, or I should say the value of a diversified rent roll. The problem that we've seen in office and retail, et cetera, is that when one or two tenants move out, your revenue could go to zero. And so we've seen the value of even a poor performing apartment complex could be 90% occupied. We consider 95% to be essentially full. I mean, you could be a little lower than that, but in the grand scheme of things, you may be below pro forma, but you still have cash coming in. And so in the case of apartments, like our lowest occupancy rate on record is 92%. Not that bad in the grand scheme of things. And now we're below 95%, but we've seen occupancy rates start to improve again with all this demand coming into the market. Now that being said, what's happening, the bigger impact is on the rent side. So more supply than demand. What's happening is now we've seen rent growth has basically dropped off and it's been frozen around 0%. In some markets across the country, it's been falling for the last 18 months or so. Nationally, we've been about zero for about a year and a half. And so with so much supply, again, the demand's out there, but you're having to compete for that demand. And you compete via price. And I'll show you some data later, but it's really not so much about affordability as it is about just competition. When people have options, even if you go to 4 and more, you're gonna, all else being equal, you're gonna get a better deal. That's what you're really gonna look for if the apartment properties are otherwise similar. And so we're seeing basically no rent growth for the last year and a half. And obviously that's been tough, especially for those who bought at the peak and expected to continue to see some kind of rent growth, and that's obviously not happening. Now, a little bit of a silver lining, if we zoom in on this last year and a half, we can see that the numbers have come up a little bit. They went from, basically 0 to 0.6%. So, it's not significant improvement, but we're now, 3 or 4 months in a row where the sequential change in year-over-year rent growth has gotten a little bit better, and I think that will continue through this year. All right, so here's a nerdy chart for you. This really summarizes what's going on right now. This is on the y-axis going up and down. This is rent growth for last year in 2024. The x-axis across is supply growth. So just for every, if we add 10 units, we add 100, that's a 10% supply growth rate. And so what it shows you is this relationship between rents and supply. And this is the reason why I feel confident that this is a supply issue, not an affordability or demand issue, et cetera. Because if you drew a line through this, you would see that there's a clean relationship between, well, we're not adding any supply, rents are still growing 3, 4, 5%. We're seeing that in, especially in, tertiary markets in the Northeast and the Midwest, places like Syracuse, Providence, Lexington, Kentucky, New Haven, Connecticut, Hartford, Lincoln. I could keep going on down this list. And so those aren't necessarily the most attractive markets from an institutional capital perspective, and they've not added a lot of supply. Rents are still growing. They're also not big demand markets either, which also contributed to them not seeing the big supply. Now look at where the supply is going, and then rents are falling. It's places like Austin, Texas. It's places like Southwest Florida. It's places like Huntsville, Alabama, Lakeland, Florida, Nashville, Tennessee. So Charlotte, Phoenix, et cetera. These are the markets that are seeing, generally speaking, a lot of demand, but even more supply, and so rents are falling. All right, so that's the tough news, and that's just the reality of the moment. The good thing about it is that when rents fall or stay flat and incomes continue to grow, we're widening the demand funnel for who can live in apartments. And so for 20, it amazes me that this stat does not get more attention than it does, even inside our industry, and certainly not in the media. We don't see this being paraded around in the headlines. But after seeing in 2021, obviously that blue line is rent growth, the green line is wage growth. And so for 2021, we obviously saw this inflationary surge in rents growing much faster than incomes. But then over the last 2+ years, we have consistently seen wages growing faster than rents. Wage growth has moderated a little bit from the inflationary peaks, but it's still strong compared to rent growth. Ultimately, this is a good thing for renters because they could, we have more people who qualify to live and rent an apartment. And obviously, it's a good thing. Well, it's painful to see no rent growth right now if you're owning. It's long-term, it's a good thing that we're widening the demand funnel. And so this is a very positive trend. It's a win-win. We all like win-wins. This is a good thing. The other thing that's a good thing is we have added, this is a crazy stat to me, since COVID hit in March of 2020, we've added almost 2 million market rate apartment households in the US. And by the way, most of this happened long before mortgage rates went up and people stopped, we stopped seeing big, home sale numbers. This is, everybody likes to oversimplify. It's about, one or the other, home sales versus rentals. It's not quite that's not really the case. And I'll talk about a little more in a little bit as we get into the outlook, but typically it's more of a rising tide boosts all ships effect. And so we've added almost 2 million renters. And what this chart shows you is the number of renter households, which is basically additionally occupied apartment units since COVID hit, and then the growth rate. And so you see Huntsville, Alabama, we've added 50% more apartment renters. We also built a lot of supply, which contributes to this, than we had when COVID first hit. DFW, Dallas, Fort Worth, has added about 120,000 more apartment renting households than we had prior to COVID. Houston, 90,000. Austin, 70,000. Phoenix, Atlanta, D.C., Denver, Charlotte, Nashville, northern New Jersey, all of these places, Orlando, all adding more than 40,000 additional apartment households. So again, the demand story has been very positive, and it's not been tied to home purchase. It's really just this broader story of household formation, decoupling roommates, young adults affording more. One thing I didn't touch on earlier, but we've also seen a reverse in the number of young adults living with parents. That's been a big shift. Everybody talked about that when the economy was weaker. More young adults living with mom and dad. There's some great data from John Burns, census data, showing that the percentage of young adults living with parents has gone down over these last few years. And for most of them, their first step is going to be into an apartment. And there's still a lot of pent-up demand still locked up in there. All right, so then with all that being said, obviously great demand, but no rent growth, a lot of supply, and obviously we have much higher rates, so apartment sales have really fallen off. All right, so the blue bars here are the number of total apartment transactions. The green line is the dollar volume, the sales volume. And so 24 and 23 are pretty similar years, but when you look at, obviously the number everybody typically focuses on is the sales volume by dollars, and that number is the lowest since 2014. But then I think the more interesting stat here is the number of total transactions, and that takes us back even further to 2012 when we actually 2011 when we last saw this few sales transactions. So obviously, one of the things that's happening right now is there's a mismatch between buyers and sellers. And I think part of the reason for this is that a lot of would-be buyers, including some of you, whether as LPs or GPs, expected to see better deals than we have. And so some of you may remember this headline in the Wall Street Journal from actually it was last summer, maybe 6 months ago. And headline was, "Office loans are toxic, but apartment loans are in bad shape too. Distress rates are rising for a type of loan that apartment flippers feasted on during the pandemic." It's typically talking about CLOs and debt funds, all right? And so as I talk to people across the country, the sentiment was, hey, we're going to see a lot of great deals. But I think, though, there was a little bit of misunderstanding about the size of this. And so I used my graphic design skills and made a little edit to this headline. Some apartment loans are in bad shape. In fact, since I'm a data nerd, I always like context. And they talk there's $80 billion of potential distress. And I'm reading this, I'm thinking, there's $2.1 trillion of debt of multifamily in the U.S. $80 billion is 3% of it. It's not that big. And so we sort of lost that context, I think. Now, having said that, I don't want to downplay the fact that distress is real. Some of you may be experiencing this right now. And so a lot of it, though, is very concentrated, and what the headline's alluding to here is in some of these kind of value-add strategies. We bought at the peak, expect to do a lot of capex investment, raise the rents, and then sell the property a couple years later. That strategy obviously worked really well until it didn't, and that's where some of these challenges are. With people with short-term floating rate debts, the rates reset, the rent growth isn't there anymore. That's when you have problems. And especially, I think where we got a little bit frothy is buying lower tier, older properties in weaker submarkets. I live in Dallas, and one of the things that we started to see was more investors coming from out of state wanting to be in Dallas, but they bought, kind of older properties in the weakest submarkets of Dallas, where you have affordability challenges, you have challenges getting the rent to where you want it to be, but they wanted to be in Dallas. And so I think, so sometimes even now I see like in Texas, there's all this distress, and there might be, but it's very concentrated in a certain type of property. And so I think as we get into the kind of the outlook, one thing that I feel confident we're going to see is more delineation between kind of your Class C apartments and your A and B. And by the way, I hate when brokers say B/C. Like, there's no such thing. B and C are separate tiers, okay? They're very different. And C is a different world. And so let me show you something here. This is, I showed you earlier rent growth versus supply growth by market. This is the same thing, but it's supply growth relative to Class C rent growth. And so here's another challenge for Class C, I think, that has to be worked out. Is that Class C rents in some of these high supplied markets are falling even harder than Class A. And so you look at, I know it's hard to read here, we're happy to share these slides, but it's places like Dallas, Phoenix, Salt Lake City, Orlando, Nashville, Charlotte, Atlanta, I said Atlanta already, so San Antonio. These are all places where they're adding a lot of supply, and Class C rents are down 5, 6, 7, 8%. And so what's happening in Class C, well, let me start from the top. Like, there's this concept that academics call filtering. And what it means is when you build a brand new apartment, which 90% of the time it's going to be Class A, higher rent, you're pulling upper income renters out of your Class B, or more realistically, probably like your B plus, A minus. They're moving up. They're saying, hey, there's a nicer, newer property, there's concessions, it's a pretty good deal. I could pay similar or just slightly more. I can afford it. I'm going to move up. Well, then that B plus property, they have to do the same. They're going to cut rents, and all of a sudden somebody who was in a C plus, B minus, they say, hey, look, there's a better located property or a slightly newer, better amenitized. I could get that for a pretty similar deal now. I'm going to do that. Now there's more availability there. I can move up. And then on down this goes. And this has been well-researched. This is not a Jay Parsons thing. This has been researched by everybody. I mean, it's academics, people unaffiliated with the industry. And it goes on down the line, multiple tiers. Then you get to the true Class C. The problem in this segment of the market is that you're already having renters who are paying a higher share of income on rent. And so the next tier down are people who cannot typically or have not been able to afford any kind of market rate rental. They're at that higher barrier. I mean, affordability is a bigger barrier for them. And so a lot of times in these situations, which by the way, it only happening in these higher supplied markets, it's not happening in New Haven, Connecticut. In these kind of markets, they're having to cut rents more in order to draw people in who previously couldn't afford it. Because that jump is more significant. So that's one thing I'm worried about with Class C, that in addition to some of the CapEx challenges when, obviously that's more expensive. And also, the fact that we saw cap rate compression from A to C get so tight in this last cycle, we're going to have to see that widen again. And speaking of affordability, I would give you just a way to illustrate this for you. So some of you may have seen this headline. It comes out, every time this story comes out from the census, all the media outlets run with this. Nearly half of renter households are cost burdened, meaning they spend more than 30% of income on rent. But one thing that the media never really talks about is the fact that it's a very bifurcated issue. We have an issue with renters, we have an issue of haves and have-nots. In that Class C and below market, we have a lot of people spending a higher percentage of income on rent. When you look at the institutional Class A and B market, you have renters who are spending 20 to 23% of income on rent. This is data from Camden, EQR, MAA, Centerspace, UDR, IRT, Elm, and then Invitation Homes, and the data from RealPage, all the renters who are renting properties that are running on the RealPage software platform. It's all low 20% range. And so what's happening I think more and more is this bifurcation of affordability issues where the top part of the market is in good shape for the most part, and we don't see affordability challenges there. Those challenges, though, are really concentrated not only in Class C but also in the sub-institutional grade multifamily and SFR. That's where some of the real challenges are. I get asked a lot about potential impact of immigration on rental housing demand. And I think it's really important to remember, it's for most new immigrants coming into this country, they're not going to qualify for Class A and B, market rate rentals anyway. A lot of times they're going to be living in kind of shadow market, lower, much more affordable rentals. And so that impact is not going to be there. So there's a number of things that I'm more concerned about Class C, not everywhere, but I think we're going to be much more selective about what can really work in the right spots. Not just buying it to have it because it's a good deal, but really kind of seeing, where does it work with, the existing rent roll, the condition of the property, the location, all of those type of things. I think someone's going to do really well in the Class C market, but there is going to be more distress concentrated in that part of the market for that reason. So I think, again, just be very strategic and cautious about it. All right, so that ties me to this next topic, which is, the distress, again, is kind of tied up to a specific niche of the multifamily sector, which gets a lot of headlines, but is actually a pretty small part of the market. And then there's a lot of capital that's chasing an entirely different part of the multifamily market. So you saw, some of you may have seen this headline last week, the Avalon Bay. They bought 8 Texas properties for more than $600 million with a cap rate in what they called the high 4% range from BSR REIT, okay? And that, again, kind of highlights this disconnect where what capital is really chasing right now, the larger capital, institutional and larger private equity and whatnot, the REITs, is they're all looking to get Class A, B+, stuff built in the last 20 years in key markets and high-quality suburbs and whatnot. This portfolio is, average age 11 years old. It's high-quality suburbs in Dallas and Austin. And that's kind of the price of admission these days. That's what everybody in the, most capital is really chasing that, and that's going to keep cap rates down. You have negative leverage, and they're really banking on this. They're banking on the supply story really dropping off. So I showed you supply. We're peaking right now. That number is going to drop off by the end of this year. It's still elevated. First half of the year, so we're still in the throes of this right now. But, supply is the easiest thing to forecast. Demand's hard to forecast. Jobs and rates, all these other things are hard to forecast. Supply, it just starts being pushed forward 18, 24 months. We know where this is going with pretty good certainty. It's going way down. And so what the buyers right now are banking on is, hey, groups like Avalon Bay and EQR and Blackstone, they have, lower cost of capital, they have dry powder. They say, hey, we're going to get in front of the line. You may not like the cap rates in the fours again, and they don't like it for the first year, but they're betting that this is going to work out for them over the long run as supply drops off, because they see supply, as I mentioned earlier, as the primary headwind. And so if the economy remains in good shape, demand remains strong, which again are ifs, but if you believe in that, then all of a sudden those deals don't look that bad. All right, so let me just give you really quickly some indicators of why I think supply really is dropping off significantly, not just for the short term, but actually I think for maybe the midterm. I don't think we're going to see supply numbers like we are now anytime again in our careers. I think it took a perfect storm of events to get to this. It took cheap debt, took COVID-era demand and rent growth. It took cap rate compression across asset classes that sent a lot of traditional value-add operators, including Madera Residential. You'll hear from Charlie Young tomorrow. And, he was traditionally buy older, value add, do the renovation. Well, when COVID hit, and really right before that even, he started to realize, hey, these spreads don't make as much sense. We're going to move up market. And a lot of other groups did the same thing, and that's what helped really drive a lot of the construction, is just, trying to, seeing a better risk-adjusted return on that new side. But anyway, 5 quick indicators that this is down. First of all, this is architect billings. Before you can build something, you got to hire an architect. Yellow line is multifamily residential. It continues to go down. They're not getting jobs right now. They're not getting hired. Number 2, NMHC survey of developers and builders. Reasons for delays. It is projects are not penciling out, and they're not economically feasible at this time. Economic uncertainty as well. So a few years ago, it was labor and material shortages. When COVID hit, those are short-term delays. They delay your project 3, 6, 9 months. When your projects don't pencil out, that's an indefinite delay. Third thing, bank lending remains tight. You could get a bank loan. You're not going to like the terms always, but they're not making it easier yet. Most banks, this is a Federal Reserve survey showing 76% of banks have not yet loosened their construction standards for construction and development. There's still some tightening it. Fourth thing, Multifamily permit levels, we're down back to mid-2010s levels, which again, really wasn't that much. We haven't just gone back to pre-COVID. We're going back to about a decade ago type of numbers with about 350,000 units being permitted over the last year. And then looking at starts versus permits. I share starts versus completions. I share this one on LinkedIn every month. That's always one of the more popular things that I share. This is the difference between how many units we complete versus how many are being started. And so this last year, or year ending January, the last 12 months, we completed about 262,000 more units than we started. And so that's that big drop-off. This is the biggest drop-off since 1975. I'm looking at starts versus completions. So that's a forward indicator, again, of where we're going. This is where apartment starts on the market rate side in 2024 were lower than any year since, and I show you by market, where this is, the last time they're at this levels. And so Houston's hasn't been this low since 2010, Kansas City since 2012, Raleigh since 2014, Dallas since 2014. Again, happy to share these slides with you. Atlanta since 2017, Salt Lake City since 2011. So, we are at long-term low, decade lows in a lot of these key markets. And so then we look at, okay, well, given this drop-off, when is supply going to get back to kind of, not just back to normal, but actually below the pre-COVID averages, which I'm defining as 2017, 2019. And again, I know this is really hard to read on the screen, a lot of stuff on here, but again, happy to share the slides. But it shows you some of the first markets in terms of the higher supply markets to reach below pre-COVID supply levels are going to be Nashville, Denver, San Antonio, Dallas, Minneapolis, Portland, Houston, Baltimore. By the end of this year, Indianapolis, Seattle, Kansas City, San Jose, DC, Virginia Beach, and Memphis will be there first part of 2026, and most other markets will be there by the second half of next year. So it's still going to take some time to work through all these units being in lease up, but again, these are all indicators that we're going to be structurally lower supplied for a while. And then let's talk about a couple things that I think could be outperforming a little bit. All right, number one, let's talk about the Sun Belt, okay? Right now, the Sun Belt's taking on the chin because of supply. This is rent growth in the Sun Belt in blue versus the major coastal markets in green. And you can see this last year and a half that the coastal markets have outperformed. Now, think to a lower supplied environment that we could have in the future, that when let's look back to the pre-COVID era, from 2013 to 2019, the Sun Belt outperformed 3.9% average annual rent growth to the coastal markets of 2.9% average annual rent growth. And so I think this is going to happen again. I mean, the demand continues to go into the Sun Belt. This is a forecast for population growth from Oxford Economics over the next 5 years. And the leaders they see in population growth are all Sun Belt and mountain markets: Austin, Raleigh, Houston, Orlando, Charlotte, Dallas, Phoenix, Jacksonville, Fort Worth, San Antonio, Atlanta, West Palm, Seattle, Nashville, Salt Lake City. That's where they see the growth going. And so if you continue to see growth, these are lower cost of living, lower rents, there's still younger populations. You have growth, but you have lesser supply. That's going to put upward pressure on rents. Within the coast, some of you looking in coastal states, the suburbs have continued to perform better than the cities themselves. I mentioned Avalon Bay and their buying strategy. I mean, they're really one of the first to really make a big deal about this, shifting to be very suburban oriented, and that strategy has generally worked out better. Your political risk, regulatory risk factors are more significant inside coastal cities. The suburbs tend to be more supply constrained and also have a little more political sanity than the core cities. Another thing I want to mention is the Midwest and Mid-Atlantic. For a long time, the Midwest was just sleepy. No one really liked the Midwest as investors, but it was really more of a mom and pop investors, small local groups that would kind of dominate all these markets. But now what we've seen is through this volatility, the COVID era was really tough for the coastal markets. The supply peak era has been really tough for the mountain and the Sun Belt states. And what we've seen is through all this, that the Midwest and Mid-Atlantic, the Baltimores, Pittsburghs, Clevelands, Minneapolis, Philadelphia, Cincinnati, St. Louis, Columbus, Ohio, on down this list, Indianapolis, they're your slow and steady. This is showing you rent growth volatility over the last 20 years, including the great financial crisis. Then all those markets have seen very little. They don't see the biggest peaks. They also have pretty high floors. And so I think there's a good case for including the Midwest and Mid-Atlantic as part of a diversified portfolio. And last thing I want to share with you is that we tend to focus a lot on big markets because that's where a lot of the capital is. Smaller markets as a whole have been outperforming. 4 of the last 5 years, markets outside the top 50 in size have outperformed the top 50 markets in size by rent growth. And it's happening in every region of the country. This is average rent growth over the last 5 years. The orange is smaller markets. The blue is major markets. Every part of the country, especially in the Northeast and the West, we're seeing smaller markets outperform. Now, the challenge of smaller markets is it's, there's higher, volatility there, higher risk. So the more of them you're in, obviously, the more this plays out. But when you pick the right smaller markets that are, well diversified and have continued growth and lesser supply, you can see, I think, a really good story there. And so that's another segment of the market that I would feel pretty bullish on, assuming you're in the right ones. So with that, I'm going to wrap it up. Just want to give a quick plug. If the Rent Roll podcast comes out every Thursday, I have an episode out right now on tertiary markets if you're interested. And thank you again for your time.
Thank you, sir. Jay Parsons, thank you so much. Thanks, Jay. Before you go. So, would the summary of your presentation be, hey, folks, stick around. Supply's coming down, and the opportunity's coming back in multifamily? Is that a decent
Absolutely,
punchline?
yeah. Just be smart about what you're doing, yeah.
Just be smart about what you're doing. All right, so we need some creative execution until we get there.
Absolutely.
All right, one more round of applause for Jay. Thank you so much.
Thanks, everybody.